What up, peeps? Top of the hour. That would be 1 o'clock Eastern Time. Swizz here, August 16th. That's Q16. Dan Nathan's joining me, as always, unless he's on vacation, which he's entitled to. By the way, people, take your vacation, okay? Nobody lies on their deathbed saying, gee, I took too much vacation. I'm just putting it out there. That's sort of my thought of the day. Today's market call brought to you by Dan by CME Group, where risk meets opportunity. We are powered by open exchange. I'm powered by some unknown substance. I'll tell you, about 40 minutes ago, I had a bowl of Special K. It was fantastic. How are you, Dan?
Oh my goodness. We should drop a little knowledge, a little inside CNBC Fast Money baseball about vacation. When we get there, we'll get a rundown. We'll say, hey, listen, you're going to be on the show tomorrow night. Here are the co-hosts. Here's the, that sort of thing. And if you don't see Melissa Lee, what do you always say to her? You immediately text her or email her and you say,
I said, when were you going to tell me? When were you going to tell me that
and what did she say? And what did she say to you?
She said, I just did.
She said,
which is so rude.
Right
I mean,
now.
I just so the folks watching this, I mean, she's so mean to me. I have feelings too. I actually said that to her once. I said, I have feelings too. And you know what she said? I know. I mean, that's cold-blooded, man. That's cold-blooded.
She loves you to death. But that thing, it never gets old. We've been doing it for a very long time. When were you going to tell us? I'm telling you now. Yeah. All right, let's talk about this thing, guy, because we got a war of words here. It seems like the market rally, the stock market rally, is pulling out. I don't know, what is it pulling out? We're seeing a lot of people saying, hey, maybe it's done. Maybe a little too far, too fast. You know what I mean? Like some of those perma bulls, they got to call the bottom the whole way down. You get a nice 15% rally. You can take a victory lap. Some are saying that they think that we can get back to new highs. But here's a couple voices here of a perma bear, someone who's known to put on the biggest short. And then Jamie Dimon, who I think, I want to talk about this Jamie Dimon stuff, guy, because, Jamie has been, somewhat negative on the economy. He doesn't often talk about markets, if you will. Curious because this call that he did with wealthy clients last week, Yahoo Finance was reporting on it, definitely got some ink this week.
Well, something worse than a recession is not a good thing. I think we all know what worse than a recession is. And I'll say this about Jamie Dimon. He really hasn't wavered on this. I mean, if you think about it, some of the language he uses continues to get more and more, I mean, I guess for lack of a better word, dire. So he clearly sees something. And I would submit, and I've said this now for the last, I want to say 18 months or so, I would say for 12% of our fellow citizens here in the United States, it already is something worse than a recession. I just don't think we acknowledge it, number one. And listen, I think that's a bit of a tail risk. I don't think he's suggesting it's a 50-50 thing. But what he's saying is there's a chance of that happening. And I don't disagree with that. I mean, if you look around, a lot of strange things are happening. The only thing that's sort of giving people confidence right now is the fact that the Dow and the S&P has rallied somewhat 14% or so from the bottom. I mean, that's really, if you really want to get down to brass tacks, that's what people are holding their hopes on. Somehow the Dow is some barometer of what's going on. But quite frankly, I think anything can be further from the truth.
Yeah, guy, there is another data point. We've been talking about it a lot. What's been going on in with jobs is actually really important. And I think it's something that we're going to continue to kind of, contend with over the next few months. And I think that it will help dictate what actually happens with the economy, whether we just have a run-of-the-mill recession, we have a deep one, something worse than that. Because, if you look at that jobs data that we got for July, we talked about it a bunch, it's still really hot, so unless we see unemployment tick up, that might be also something as a decent barometer of the sort of landing this economy has. And I know you recall this last week. We had from Moody's, Mark Zandi, who I think is a very good economist but he was speaking, this was on Fast Money. He was talking about the resilient economy, the resilient consumer. And the point that I kind of pushed back after he was done was like, how resilient are we when we have these sorts of shocks to our economic system and we have to throw trillions of dollars of monetary and fiscal stimulus at it? So to me, thinking about, an economy in 2022 that did not have all of that over the last few years, the economy was already starting to weaken in 2019 pre-pandemic. The economy was really, growing at 2.2% for years. You know what I mean? So I don't know. I take some issue with that, guy. But here, I just want to get your take on, Dr. Doom. If you're an economist and you're called Dr. Doom, you're probably a perma bear. So you see what Nouriel Roubini is expecting here. He thinks investors are delusional if they expect the Fed to pivot and cutting interest rates next year. What is your thoughts there?
That one's so it's interesting. I probably part ways with him a little bit because I do think towards the end of next year, that's probably what we're going to see, but we're going to see it for the wrong reasons. But with that said, I totally get what he's saying with this. The fact that they're delusional, I mean, what he's saying is
wrong reasons. Though. Explain wrong reasons. Why? So you think you disagree with him? You think they will cut next year, and what will the reasons be?
Because things go basically to shit, and they're going to be forced to. They're going to be forced to do what they've always done when things start to go a little bit pear-shaped, and that's come back with accommodative policy. That's what I think is going to happen. I mean, let's put it this way. They're not cutting interest rates because things are going to be great. And I think that's what's going to happen in the back half of next year. And to a certain extent, if you look at sort of the FedWatch tool, it suggests that as well. And we've said it for a long time. So we're on the same page. Yeah. We're probably looking at a different word. But with that said, you also have to look at what Michael Burry just said. And people say, that guy's always negative. First of all, that's not true. And if you go back to last summer, Dan, and I know you know this because we talked about it, he was a guy that came out and said, you know what, you got to short the ARK ETF. And he literally top ticked that thing. It never looked back. So he's the first person to say he's typically early. In the case of last summer, he was literally to the day. Yeah. And, the fact that he's getting out of his stocks here, say what you want. I mean, the guy's always negative, blah, blah, blah. Certain people do certain things. Jamie Dimon says something. Nouriel Roubini says something. Michael Burry says something. You have to take notice. You don't have to heed their warnings, but you absolutely have to listen to their warnings.
Yeah, well, that's a fact here. All right, let's look at this real quickly before we get out of these kind of, I don't know what you would call it, a cornucopia of kind of negative thoughts about
you used the word cacophony of negativity before.
Well, cacophony would explain like just the voices of them, right? Not a cornucopia. That's more of a basket of some oddly shaped vegetables, right?
Gourds.
Usually autumnal vegetables.
Autumnal, yes. By the way, before you know it, you're going to be out there picking pumpkins and all that stuff. So enjoy that.
Not my jam. All right. Well, real quickly here, Bank of America says investors are no longer apocalyptically bearish as fund managers' cash holdings dip to 5.7% from 6.1%. Guy, talk to me about those percentages. I mean, listen, Lisa Abramovich, she puts this data out here on the Twitter. Really, we're talking about a sentiment shift here, right? Mm-hmm. So again, we've had a big move in the stock market. You'd expect bearish sentiment by investors to come down as the market goes up, which basically brings us to the S&P 500. Carter was on with us yesterday, worth charting. He drew this line. I'm drawing it again today. This is the S&P futures here, guy. You see that we went from the Jan 2nd high to the late March high to now where we are. We're probably, a few handles away or 10, 20 handles away from that downtrend. The 200-day moving average is at 43, 22 or so, lines up with that downtrend. What happens here, guy? Nostradamus, talk to me.
It's interesting. If Carter's on Mondays and Wednesdays, which in my world are odd days, today being Tuesdays an even day. If he were here, he would say the line draws itself to the penny. And that's exactly what's going on. I mean, you still have a sloping downward moving average. That's not bullish. And you traded up to this downtrend line, which is something we've been talking about for quite some time. So here we are. I would submit that today is going to be the day. And listen, I've been wrong so much. And we've had a lot right, a lot wrong. But this is one of those days you have to watch very closely. I happen to think we're going to reverse today, and that 43.04 is going to look more like 42.68 by day's end. I want you to sort of bookmark that, and we'll talk about it tomorrow on Market Call, because the scenario sets up really well for exactly that. Everybody getting all invigorated by Walmart, which we'll talk about. I mean, it wasn't near. It's funny. You lower guidance, and then you beat lowered guidance, and everybody gets all excited. But then you say, wait a second. It still ain't that great. So we'll talk about that. I get it. But today's one of those days where I think we could start things getting a little softer as the day progresses. So I look at this ES1 chart, the futures chart, and to me, did everything it needed to do. Moving average is still sloping lower. I think it sells off from here.
Yeah, interestingly, I mean, it's just somebody who loves to be a little bit precise here. You'd love to see those, these indices. Let's look at the NASDAQ futures really quickly here, too. You'd love to see them kind of kiss that 200-day, right? Because, again, if these lines, have any relevance, it's usually because a lot of people are looking at the same levels, right? They're looking at the same smoothing mechanisms, moving averages, that sort of thing. They set stops in things like futures in the S&P and the NASDAQ in and around those levels. That's often why you see things bounce at support and get rejected at resistance. And the NASDAQ 100 futures here, Guy, this one got through that downtrend, but you could say that 13,650 level or something like that is maybe an important resistance level. That's where it broke down in late April. And when it broke down from that level, it went straight to 13,000, then straight to 12,000. So again, we'll talk in a few minutes about some of the rotations that are going on in the market that kind of maybe speak to why the NASDAQ overshot, but the S&P has not gotten there yet.
Yeah, and I think just for historical context, and we've talked about this for a while, I mean, if you remember when the markets were going higher, the NASDAQ never really backed up, or the NASDAQ never really reinforced that S&P move, right? It was never commensurate with the S&P move to the upside. Now the NASDAQ seems to be outperforming on the short term. So I think the same type of thing could happen. I mean, maybe this is the reverse of what we saw effectively 8 or 9 months ago in terms of now we're seeing the outperformance in the NASDAQ. But again, I just think this is a precursor, again, of this next downdraft. Again, we thought 4,100, overshoot to 4,200, we're at 4,300 in the S&P. So things do happen, but keep your eye on today because I'm telling you it's going to be one of those days we look back upon in the weeks to come.
4268, Guy, it is bookmarked there. All right, let's talk about that point that you...
By the way, if that does happen, I'm just telling you people now. I will come on Market Call tomorrow, and I'll be all fired up. I'll get in Tom Sosnoff's grill like friggin' Richard Dent for the Chicago Bears against some Scribino quarterback. Anyway, back to you.
Just so you know, Richard Dent, I grew up, he was a defensive end. He was a wrecking ball, that guy, right? And he was on that 85 Bears team. I was at the opening night in the September 2019 NFL season at Soldier Field, Guy.
Monday Night Football.
They were playing, well, it was Thursday Night Football. The Packers of Green Bay. Sure. And I was in a box at halftime with Richard Dent and with Otis Wilson, and it was pretty cool, man. Just for, just to
That's
tell
not,
you that,
they must, and I bet you know what they said, what they're saying right now on their podcast or their Market Call. They're like, I was in a booth with Dan Nathan for Market Call.
You know what's really funny? I'll tell you this, because Richard Dent's obviously a Hall of Famer here, but I was wearing a throwback jersey of Mike Ditka when he was a Bear, okay? And they did not dig on my jersey. They did not think it was particularly cool. They just, you read all about that kind of, the offense versus the defense, Buddy Ryan's defense and Ditka's offense there. They were not big fans of each other, guys.
They were buddies, guys, no doubt. And I don't think a lot of people like Ditka. Jim McMahon didn't like Ditka. I don't think a lot of people really liked him. Buddy Ryan didn't like Mike Ditka. I don't think Mike Ditka likes Mike Ditka. By the way, he played for the Dallas Cowboys as well, tight end. I think Ditka's in the Hall of Fame, but why are we talking? I mean, I can't. It's amazing.
My bad. You mentioned Richard Dent.
I did it. I apologize. Let's please move
on. All right,
on.
let's do this really quickly because we were talking about you were just saying the NASDAQ's overshoot and why. Okay, well, just look at this. And again, there's a couple of downgrades this morning. One of Snowflake, and I think this is a really interesting one. UBS downgrades to neutral. The stock had a big run off of its June lows, Guy, and its highs or recent highs last week. The stock was up 60%. Okay, well, here's the deal. At its lows in June, the stock was down 73%. Now, the thing has a $51 billion market cap right now. It trades about 10 times sales here. Do the math on the market cap that was gained off the June lows. You could do that quite easily, right? We're up about 55%, and now we have a $51 billion market cap. Off of the highs, though, I mean, this was over a $100 billion market cap. It was trading about 25 times sales, Guy, at its highs here. What do you make of these sorts of calls? I drew a couple lines here. Snow is dealing with this 162 level, is a big breakdown level in May, okay, when his low is 110 or so. Here we are at 162. You see that uptrend's in place. Technicals really don't matter for a name like this. If they were to guide down based on enterprise demand weakening, what does it mean for the NASDAQ?
It means, well, The read through for the NASDAQ should be really bad because this is a great tell for exactly what you just said. So you could start to look at a host of different companies that theoretically should be affected by that. Number one, not unlike when we talked about what the name escapes me, but when you brought it up on Fast Money a month or so ago. Anyhow, it wasn't this. It wasn't the size of the name. It was it was the company from Bill McDermott. Help me out there. ServiceNow.
ServiceNow. Yeah,
And if you go back and listen to what he said on Jim Cramer's show, that theoretically should have had huge ramifications, and it did for a couple days, and everything shrugged it off. But to answer your question, if Snowflake were to say that, the stock would probably immediately be 125, 130, and I think it would the knock-on effect would be the Microsofts and the Oracles and even the Googles potentially could all come under the spell or under the sort of the auspices of their negativity.
Yeah, well, I think the main point there, it's not just kind of SaaS that sell into enterprise. When you think of some of these big platform companies, to your point, Google, Amazon, Microsoft, they all have these big, cloud, public cloud businesses, and that would just kind of be the read through, no doubt about that. Guy, let's quickly look at a Zoom downgrade. Also, again, this was a pandemic winner, and was trading at a crazy multiple. It's had a big run off its lows, but it's really gone sideways for the last couple months. It had that kind of mid-May kind of like bloodletting, and at the time I think it was down nearly 80% from its all-time high. Really flatlined here. I mean, competition, again, you and I talked about this. If any of these guys like Microsoft, Cisco has an offering, I mean, there's no shortage of offerings. Salesforce has Slack now. This is a $32 billion market cap company that's down 40% in the year. It's down a whole heck of a lot more from the highs here. How does a company like this kind of come back? It still trades at kind of a fat multiple, 7 times sales, and it's really not growing on a GAAP basis, not that profitable, and sales are only expected to grow about 11-12% a year for the next few years. Not a multiple that screams buy me here, huh?
No, and to answer that question, how does this company come back? They don't come back. Now, that's not to suggest it's not a great company. That's not the point. They have a great service. It's to suggest it should have never been a $400 stock, number one, and we probably talked about it at the time. And it probably finds a level that it makes sense. I don't think this is a level, though, the upside. I mean, Zoom is probably not going anywhere. Competition is coming, but Zoom will be part of that narrative without question. It'll just be part of that narrative at a much lower valuation and subsequently a much lower stock price. By the way, you've said this a number of times. It wasn't Zoom's fault that the market took it to $400 last fall, right? I mean, it wasn't their fault. I mean, they probably should have done an offering or more offerings if they did one. It's the market's fault. And at a certain point, it's going to be the market's fault that it probably will overshoot to the downside. It will find an equilibrium. I don't think it's at this current price, though.
Yeah, here's one, though, guy. People have been asking us about it, and here's a guy, Robert Mills. Maybe he's Jeff Mills' relative, our friend, the general from
By the
Fast
way,
Money.
how funny was it the other night? I mean, we fricasseed Mills. And just so the folks at home know, I love Jeff Mills. I think he's fantastic, but we broke his horns in a major way. Anyway, back to you.
He's a good sport here, but let's talk about this Adobe here because this would fit in that kind of enterprise software bucket, and also one where this is not a cheap stock, guy. This stock, trades at about 12 times sales. Okay, those sales are expected to grow low teens at best for the next few years, and what I think is really fascinating here is this is a $200 billion market cap company.
Huge
the stock
company.
Traded, as high as $700 in November, traded as low as $350, so it was down. You can do that math. 50% right now. It's down about 35% or so. This one, again, if we're talking about how does the market bottom, you need stocks like this that trade at multiples that people were willing to justify, right, in boom periods. You need them to overshoot to the downside, just like they did to the upside. This one still seems very fat to me, guy.
There was a period of time when pre-COVID probably, or maybe even early in COVID, Adobe would come out, and I only remember this because it happened with such frequency. The stock would run up into earnings, they'd report, the stock would sell off. I'd say give it a couple days, within a week it'll be making a new all-time high. And that happened, I would say, at least 4 or 5 times over the course of however, couple of years. I remember the last time I said that, and I think it was probably, I don't know, on the fall of last year. I remember you saying something like, "Have at it," that's your want to say, and you brought up everything you just brought up now in terms of valuation, and that proved to be spot on. The stock is still expensive here, and it was easy to justify its valuation when money was zero and valuations didn't matter. It's very hard to basically wrap your head around the valuation where money's getting tighter and valuations do matter. So it's a very important company. It's a great company. I don't think it's necessarily a great stock to own right here, though.
Yeah. I mean, again, just a correction. I think I said 15 times sales, 12 times sales, topped out at about 20 times sales in November. Again, the stock got cut in half from those levels here. But, there needs to be some kind of rationale behind these valuations here. And this one doesn't seem to have it. Maybe there's
and
one
it's not,
more.
I mean, and this is not a takeout candidate to your point about its market cap. So, you're basically relying on organic growth from them, and it's probably just not that environment for it. Anyway, sorry about that.
Yeah, hey, here's one really quickly. Here's Gregory Cook tweets at us here. He's watching the fine program.
Love this.
Is the move over in Snap Netflix? Are you still in these
Snap
trades?
is your baby.
Yeah, well, listen, I am still in Snap, and I'm looking at this stock at 12.61, and I originally bought it in May at 12.80. It went to 16.35 the day before its earnings last month, and I didn't sell any. I probably should have. Traded all the way down to below 10. I got my average down, and I talked about it here, to 10.5. Well, here we are now. I mean, this is one way to trade. It was a bit of a widowmaker for a bit there. Here I am now. I'm up $2. My average is 10.50. It's at 12.60. Might I sell a little bit? I see a gap to be filled back towards that kind of $14.5, $15 level. That's where maybe I take half of that off. Netflix just, again, I started buying that in May. It had such a big run. I am out of that. But again, I don't think that there's a gap there to be filled. I'd love to kind of maybe buy that again if it were to come in. And real quickly, guys, Shop. I started buying this in the low 30s, got to about 40. I am out of a little bit. I'm still there. And Square, I'm not a fan. It had a big move. I'm long the PayPal, which I bought pretty decently again. So I'm out of Meta. I bought a bunch of these internet names when I just thought they went too far to the downside. Sentiment got way too negative, but I still like Snap. I still like Shop. I will get back in Netflix. I will not get back in Meta. I really like PayPal, and I'd love to see it pull back a little bit and buy some of that. There you go, guy.
The tell in Shop, by the way, was, if you recall, the day before earnings, they had a big headcount reduction, and I think the stock traded down to 28.5. And I actually said on Fast Monday that night that they're going to report tomorrow. I'm telling you people now, if that stock doesn't go negative, don't fade the rally, and that's proven to be correct. By the way, major double bottoms there for those playing at home in Shopify. Let's continue here, Dan, because the biggest retailer on planet Earth in terms of just revenue, or sales, I should say, is Walmart. You think about it. Walmart, I mean, think about this number. They'll do close to $2 billion-ish a day in sales. It's a little less than that, but just for rounding up, just for emphasis. I mean, it's a staggering number. Yeah. Obviously, the problem, well, not the problem, but it's a margin game, right? And I will tell you, I mean, this quarter was better than expected, but, they beat lowered guidance, and people are getting all giddy, which is fine, except that now we're at levels you have to say to yourself, wait a second, hold on, wait a second, slow down. Walmart's now trading at probably, I would imagine, given this run, 24 times or so next year's numbers. About to fill that gap, if we haven't already, that we actually talked about, but now we have other gaps that we just created on the downside. So I said it on Fast Money last night. I said, listen, if Mike Coco Beware is right and the options that he flagged, those 140 calls, come to fruition, if it gets to 140, you pull the ripcord, take some profits, and move on. What are your thoughts?
Yeah, well, I think interestingly enough, I mean, the gap right to that 200-day moving average, guy, is about 139 or so. So here we are firmly above it. Its ability to kind of not only hold on to those gains, but take the whole sector up with it is pretty impressive. Yesterday, we did talk about when it gapped lower from 132 down to 120. The fact that it filled in that gap really quickly is really telling about investors and their positioning in the space. And, it makes sense, guy, to take a step back here and talk about that a little bit. So if you want to isolate this chart and, at home or whatever you're using to kind of look at these charts, when you look at that move that the stock had in late June into July, right? And it ran from $118 to $132. And then you have this unexpected pre-announcement. No one saw that coming except one options trader. Remember, we highlighted the fact that there was a lot of put buying in that. And then you see the stock, just fill in that gap so quickly. That tells you, for the most part, it tells me that investors made up their mind about this thing. So to see another gap to the upside going the opposite way, that makes some sense to me, that investors have basically gotten their arms around valuation. They've gotten their arms around what they think the worst of these inventory issues are. And maybe with some of the data that we see about inflation coming down, makes you feel a little bit better about the U.S. consumer. Thoughts there, Guy?
I've made up my mind. I ain't wasting no more time, in the immortal words of Whitesnake. And I don't think you should waste time in terms of taking profits here. It's already traded 23 million shares, typically trades 9. We're probably going to trade, I don't know, probably close to 5 times normal volume after all is said and done. To me, that's capitulation. And again, I think people are getting giddy over a not so great quarter. It's great in the context of they beat lowered expectations, but this is not great by any expectation. The price action is great, and we'll see what Target has to say as well. I think you bring up a good point, but these are, I think, rallies that you want to, I think, fade and sell into, especially if you're obviously long the stocks.
Well, talking about Target, that's going to be out, in the next, tomorrow morning
24
or so.
hours.
Yeah, so this is one, again, and we made this point yesterday, I think, into the Walmart quarter. I mean, getting in front of some of these stories doesn't make a whole heck of a lot of sense, especially when you see a lot of these gaps. I mean, yeah, you could say, I think that Target is not going to have done as well as Walmart with their inventory issues, and maybe their consumer's a little different, and maybe their just execution is poor, and you could say this is the perfect level to short this stock again. It is right at that kind of, that February low, right before it gapped higher, Guy. I mean, like, all the lines, work, I guess, but if you have a better than expected number, given investor interest in the rotation into some of these names, okay, could you have this stock back above 200 at that 200-day moving average on a beat and raise? Average.
And listen, you can make the reason to be in Target over Walmart historically has been valuation, and that was right for a while. And then obviously you saw the disaster that came out in terms of what Target said with their inventory mix and all those things. What I'm going to love tomorrow, if in fact Target does trade higher, is all the people, pounding their chest saying what a great company Target is, blah, 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 and, how they've been buying it all the way down. That's such complete horseshit, but that's neither here nor there. I think it's the same situation now. These retailers are not out of the woods, number one, with their inventory. They're not out of the woods with their consumer. By the way, Dan, 235 million, $250 million credit cards have been issued, new credit cards since April. U.S. credit card debt is now north of $1 trillion. So think about that for a second. So for all you people out there listening to these pundits tell you what a great shape the U.S. consumer's in, it ain't true. I mean, they're in great shape in terms of buying things. Yeah. They ain't in great shape in terms of their balance sheet. And I think at a certain point, this catches up with the retail sector and catches up with Targets and Walmarts.
Yeah, I get you, man. And, we talk about debt and we talk about the drag on growth. And I think that this next slide that we have, here's a woman that you and I know and have a ton of respect for, Rebecca Patterson, who's over there. No, Rebecca Patterson over there.
Can I tell you something? I dig her. She's a badass, man. She is.
Wait, the longer the base, higher in space.
Right,
that was her
Louise.
saying.
That's not
but you know who doesn't say that? Rebecca Patterson over there at Bridgewater. Bridgewater is one of the largest hedge funds on the planet. We've known Rebecca since she's been doing CNBC for years and years. I think a great strategist here, and she's basically talking about the likelihood that the Fed is not going to stick to the landing, and the likelihood that we're going to be in a stagflationary environment, and what that means for growth. And to your point about that, U.S. consumer levering up right now as rates are going higher, as a lot of the tailwinds to their balance sheets are fading off after the pandemic. Not a great scenario. But what does it mean? We just talked about what we think it means for stocks, right? For growth there. But rates are really kind of telling the story here too, Guy. And if you look at the 10-year, you had thought for a long time that rates were going to go back up to those 2018 highs here. We overshot a little bit, and here we are. If you look at that 5-year chart, it really doesn't look like a bullish setup for yields, in my opinion, which is a reflection, I think, on what the smartest investors out there, and I put Bridgewater in there as a stagflationary environment where growth's going to be low, right? But prices of some of these things that moved higher stick around and they really weigh on corporate margins. Is that what yields are telling you right now, guys?
Just a 5-year chart, so it doesn't really illustrate the volatility we've seen recently. Yeah. I mean, 330 down to 2.5 up to current levels, and there are a lot of fluctuations in between that. I think the bond market is still trying to figure out what's going on. I will tell you, and this is just my opinion, if 10-year yields go higher here, it doesn't mean it's going higher because growth is getting better. Quite the contrary. It's probably going higher because inflation is still a concern. On the flip side, if 10-year yields start to go back down to 2.5%, historically a bullish thing for equities, it suggests that the bond market is catching on to the fact that growth is slowing. So in my mind, as small as it is, I can't wrap my head around either scenario being bullish for equities. And, right now, I think the bond market is struggling, in my opinion, as much as I'm trying to struggle with the broader market, trying to figure it out. It doesn't know where 10-year yields should be. And listen, you watch the way it's traded over the last month and a half, 2 months. I think that backs up my point.
Yeah, just to bring this thing full circle to the way we started this conversation, though, about debt and its drag on growth, okay? Look at this chart over 40 years, okay, going back to 1980 of the 10-year U.S. Treasury yield. It was above 10% back then. Upper left, bottom right. Okay, when you look at this extraordinary period that we have just gone through, the U.S. Federal Reserve has just raised interest rates nearly 3% in a matter of, 4 or 5 months. It's got to be the fastest increase of that size ever. So here we are. We've had this huge move in 10-year yields, and they've really gotten stuck right at that long-term downtrend. And Guy, again, if you think about where the Fed balance sheet is and its impact on growth, I really think that you're going to see this 10-year yield back towards 2%. And then in the next crisis that we have, and it is coming, and it might be in the form of a credit crisis, you're going to see the 10-year back at those 2000, I don't know, what is that double bottom low that we saw, 1.5% or so. So that's my take here. I'm not, some fancy strategist at some fancy hedge fund. I just don't see yields ever going up meaningfully unless inflation is just so run away to a point that makes early 70s or what we saw then in the 70s look like a child's game.
And one of your points was with the amount of debt we have, if you look at just, national debt and all those things, the Fed's balance sheet, I mean, it'd be catastrophic if rates went meaningfully higher. I totally get that. But the flip side of that, if it gets rates back down to 1.5% in the 10-year, again, in my mind, something catastrophic is equally happening on the downside. So we'll see. We should also look, because this is what we do since it's CME day, we should look at the CME Fed Watch tool, which is something we look at every day. I mean, I don't think all that much has changed. I mean, obviously, over the last month or so, things have changed. But over the last couple of weeks, things seemingly about the same as we've seen them, Dan.
Yeah, I mean, again, we went a month ago prior to that Fed meeting in late July to a very high probability of a 75 basis point hike. That's what the CME Fed Watch tool was telling us then. You see now it looks much more likely that we see a 50 basis point rise. We have the Fed minutes that are coming out tomorrow, believe it or not. I think that will be closely watched just to give a sense of kind of, the direction here or whether if traders have it correct. So again, if we see, expectations ratchet up for, greater rate hikes, that means inflation, or at least some of the readings that are followed closely by the Fed and large investors and strategists, are not trending in the right direction, which kind of brings us to the dollar here, Guy. The U.S. Dollar here, the Dixie index, 50% of that is the euro. We know that euro's had a tough slog here. Again, the Fed's been raising, the dollar's been going higher. You also have, the issues with the Eurozone, which has put upward pressure on it too. But it's contending with that uptrend right now since earlier this year, Guy, when it really took off, right? When, around the time where Russia invaded Ukraine, maybe that was a flight to quality. But this chart, you know what this chart looks like to me, buddy?
Well, I tell you what, I'm not the brightest bulb in the fixture, as you know, but that looks like the hungry alligator to me, Dan.
Yeah, well, it does. And so, again, let's just talk about this. If we were to see the dollar move lower, okay, it had that big rise from, 100 to about 108. And here we are, we're contending with that uptrend, 104 and a half ish or something like that. That might be helpful, I think, for U.S. multinationals a little bit here, right? I mean, so just thoughts on a weakening dollar and what that might mean for corporate earnings.
If the dollar weakens, it's because the market perceives or believes that the Fed is going to pause or pivot, or actually, to that Nouriel tweet earlier in our show, actually lower rates in the back half of next year. So a weakening dollar is, I think, predicated on the fact that the Fed's going to sort of give it up and basically change course once again. That's why the dollar would sell off, but that's why commodities would go higher as well, which leads us to our next chart. And again, invoking Lisa Abramowitz twice in one show, which is remarkable. But here we are in Crude, Dan. Well done by you. I mean, she talks about a Rorschach test. I can't either spell nor say that. Of course, my feeble mind, I think of the great Arnold Rorschach of Welcome Back Kotter fame. What are your thoughts here? It looks like we're breaking down in a meaningful way each and every day.
Yeah, and she kind of lays this out pretty correctly. And you and I have been talking about this. We talked about it on Fast Money. I mean, either the precipitous drop in crude here and getting back to levels where it topped out back in November, she's saying that either it's emblematic of a global economy in decline and careening towards recession, or it's a normalization of crude values that takes much needed inflationary pressure off companies. Again, it overshot to the upside on two occasions this year. Might it overshoot on the downside? And again, to me, I don't trade crude, but I trade stocks in and around it. And I also think of it as a big important input to a lot of companies here. This is not a great looking chart. I mean, I could see this thing getting back to that uptrend that's been in place since the start of 2021, guy. And that point, you might see a bit of a consolidation, right? Where, the players who were so convicted about much higher prices, or the players that think that it should be back at $60 a barrel, maybe it finds some sort of equilibrium after both itches have been scratched, if you will.
Oh, I like that.
Yeah, but I'm just not playing for a big move higher right now. It would take some sort of geopolitical event. But the other thing I just want to make the point is, like, there are so many things in the China data that we saw over the weekend, we talked about yesterday, that are really speaking to the fact that it doesn't feel like there's going to be this post-pandemic boom. Where are all these people? And I got to tell you, absolute bullshit. All of these people with the roaring 20s, was that the dumbest and the laziest sort of like thought process about what comes after one of the worst couple years that we've had in the global, for the planet, I think, in modern times.
Well, the back end of the roaring 20s weren't all that good for you history majors out there, but I won't get into that. And it was a little lazy. And listen, crude oil is important, but I'll say the flip side of crude oil, not that I'm trying to play devil's advocate here, nat gas continues to go up seemingly every day. And for industries, nat gas is a huge input. We'll talk about that on another show. Here's your crude chart and futures. I mean, you drew the line, Dan. Past resistance becomes support. We're finding it here probably around 87. You drew the uptrend line, probably comes in over time decay right around 80. We'll see how it plays out. But the next thing we have to look at is your baby. I like to say BK is the original Bitcoin baller, but you're not far behind, Dan Nathan.
I am anything but that. I think what you think it's my baby is that between the two of us, I spent a little time on it. I mean, listen, their stuff. You've actually had a great macro call. I think that you thinking about it as a macro asset, not for the reasons that people, like some of these hardcore crypto people, the censorship resistance, all that sort of stuff. You think about it as another input when you see the dollar do this, when you see the rates do this. And I've actually learned a lot from you about that relative to gold. I think about it more from an innovation standpoint, when it may be the innovation of, let's say, money. I also think that Ethereum has been very interesting to me, just all the development that goes on top of a smart contract layer 1 blockchain. So to me, I've been more focused on Ethereum. I will say this, I started buying again in May, around 2000, where it is right now, all the way down, and I got a good average on it, but I am lightening up pretty dramatically here, Guy. There's this merge that's going to happen, a proof of work to a proof of stake. It's just the way that basically ETH is kind of created and used, and it just really speaks to the speed and the cost of using that network. And I think it's become a consensus trade here. So again, at technical levels here, at sentiment levels, I've sold a lot of that over the last couple of days. So just a quick update here, and we've gone way.
I mean, we're an extra, and we're in the OT here. By the way, I love the OT.
It's a new show on CNBC from our friend Scott Wapner, who it's called The Overtime. It's the closing bell overtime, the OT.
Yeah, the OT. No, because it's the overtime halftime, and then you play the second.
No, halftime is a show at noon.
Yeah.
And so it's the halfway point of the market day. Market closes at 4. So then anything that happens in that 4 to 5 o'clock hour is the OT.
Yeah. Okay, I'll think about
and
that.
Then you know what comes on at 5 o'clock?
CNBC's Fast Money, which if we make it to January, and no, I don't know anything, but I've been saying if since January of 07, because you just never know in TV. It'll be 16 years. Some of you people weren't born yet that are watching this. And if you are 16 and watching this, what the hell are you doing? Go outside and play. But that's it for today's market call. I want to thank our sponsors, CME Group, Dan, where risk meets opportunity, powered by Open Exchange. If you enjoy the show, like our videos, leave us a comment. We'd like to hear from you, good or bad. Send me the bad, send Dan the good. Dan and I will be back tomorrow with Tom Sosnoff of Tasty Trade, and of course, the aforementioned Carter Braxton Worth charting. Audi 5000, bitches.
Whoa, what the...